Hello and welcome everyone. Thank you so much for joining us. This is part of our video series marking the launch of Bold, and today you're going to hear all about the most important asset in financial markets right now, gold. I'm Kit Winder, I'm the senior analyst here at ByteTree, and I'm just delighted to have you all here for what should be a fantastic conversation. After 5 years of financial innovation and hard labour, the 21 shares Bitcoin and Gold ETP Bold launched on the London Stock Exchange on Tuesday morning at 8 a.m. Charlie Morris, our founder and the creator of the Bold Index, rang the bell and spoke with Isabella Kaminska about the role of Bitcoin and gold to multi-asset investors, plus how he crafted Bold to combine the world's two most significant alternative assets into an ETP. Today, alongside Charlie once again, we welcome another incredible guest. We're here to focus on one half of the risk equation that sits at the heart of Bold, and that is gold. And so in that regard, we're incredibly fortunate to have John Reade with us today. John is the senior market strategist at the World Gold Council and one of its principal spokespeople. He has 40 years of experience in the gold industry, both on the mining side and on the investment side. And he holds a mining engineering degree from Imperial College. There's no one better for investors to hear from, with geopolitics reasserting its muscular presence on global affairs once again, and the global money supply ticking ever higher in the background. So thank you very much for joining us, John. Now, Charlie is going to kick off, I think, by running through the core elements of the Bold investment thesis before we get into the broader discussion around the assets and the macro. But the final thing to say before we get going is that this is not investment advice. Nothing should be taken as an investment recommendation. And with that said, over to you, Charlie.
Thank you, Kit. Right, John and Kit, I'm going to tell you about the Bold Index and why it is what it is. And I'll start with a quote from Ray Dalio, the great fund manager, who said, I would take the gold and I would like to sprinkle a little bit of Bitcoin into that mix too. And that sets us up for what we've done, which is precisely what Ray suggested we should do. So at ByteTree, we build diversified portfolios, just like Ray Dalio does. He probably does it better than us, but nevertheless. And the money map's a key part of our investment process. So above the line is Bitcoin and gold, inflationary assets. Also, you'd have index-linked bonds, tips, and value assets. For example, financial stocks and heavy industry and commodities. Below the line, we have low inflation areas of asset classes and stocks. So bonds and high-quality stocks, and equities and growth stocks. And then risk on is to the right, and risk off is to the left. And our simple thesis is that if you want to have a balanced portfolio that is inflation sensitive, then Bitcoin and gold makes an awful lot of sense. So how do we put them together? We use risk weighting, and this is based on 360-day volatility. Now, the volatility of Bitcoin was extremely high back in the day, but it's been steadily declining over the years. And is now, Bitcoin is not much more volatile than a typical large tech stock, as we'll show you later. Gold's pretty consistent. You can see that in the sort of high teens over the last 10 plus years. And that roughly holds for the last 50 years, with the exception of 1979, when gold volatility was very high for a short period. So we have this magic formula here. This is known as inverse volatility weighting. It's a standard process from the financial industry, not a ByteTree invention. And we take the 306-day volatility each month, and our index provider, which is Kaiko, based in Stockholm, they plug in at the end of the month the volatility of Bitcoin and gold on the left-hand side. They do the inverse of that number, add them together to get the blue number, do the division, and then you get the weights. They carry out that process at the end of each month. They publish that data to 21 shares, and then at the end of each month, the portfolio is rebalanced to that target weight. Now, that's the history of the target weight, and obviously we've only had a real money product for 3.7 years, April 2022. But nevertheless, the concept can be tested back to 2015. When Bitcoin's volatility was very high in 2008, late 17, 18, the weighting Bitcoin was extremely low. But when Bitcoin's been calm at other times, the weighting has been quite high. Excuse me. And today, basically, we're at 35% Bitcoin, which is the highest it's ever been, because Bitcoin volatility has been coming down so much, and gold volatility has been creeping up ever so slightly. Then there's the real life in the real world. We take our volatility measure once a month, but inside the month, prices move. And if you go back to the left of the chart in early 2024, Bitcoin was very strong as it launched on the US exchanges with ETFs. Price was very strong. So at the end of the month, we had to rebalance and sell Bitcoin and buy gold. In May, it had cooled down. We had to buy Bitcoin and sell gold. And we've been doing that consistently over the last 2 years. And all those little transactions, some of them are quite large, 4 or 5% of the portfolio. Some of them are quite small, 0.2, 0.3% of the portfolio. But in aggregate, they add considerable value. We are consistently buying low, selling high, buying the one that's gone down or underperformed and selling the one that's outperformed each month. So where are we? That's the result. You've got Bitcoin in black, you've got gold in gold, global stock market, including dividends, in red, and gold in blue. Gold has outperformed both Bitcoin and gold over the last 8 years. Now, there is a starting point here, which is disclosed at the top, which is since the Bitcoin high. Obviously, if I took this chart back further, Bitcoin would just be through the ceiling because it made so much money in 2017. But I think 8 years is a good sample to illustrate how this works. I think that the people would think that gold delivers the average of Bitcoin and gold, but it doesn't. It delivers something more. And I can illustrate that on the next slide. So this one here, you've got the orange line in the middle, and that is the average. I've taken away the equities. We've still got gold and gold and Bitcoin, but the average line of the equities. Sorry, I beg your pardon. The average line is the average of Bitcoin and gold. And you'll notice that the blue line is quite a long way ahead of that average. And that is what we call the alpha line. And that's described here. So the excess return above the average of the gold index over the past 8 years is pretty substantial. Gold's been very strong in the last few months and Bitcoin's been weak. So unsurprisingly, a 2/3 gold basket has done extremely well compared to a 50-50 passive idea. But I think the important bit is not so much the fact that gold's done so well recently, but the red line, which demonstrates the long-term benefits of the rebalancing transactions, which, although this is 150% outperformance in 8 years, which is about an 11% IRR, I think that the red line is much more like 5 to 7%. And the result, again, so we've got the return of the gold index is above both Bitcoin and gold. And then the other point is that the volatility is not in the middle of Bitcoin and gold, but actually very close to gold. So sometimes the gold index has been more volatile than gold, such as 2017-18. But generally speaking, it's been pretty close, a long way below Bitcoin, and currently the same as gold. And this is possible because of the low correlation between the assets. If the assets were correlated, then the gold index would sit in the middle. But it's not. They're not. They have low correlation, so there's a diversification benefit from putting them together. And I mentioned the big tech stocks before. Tesla and Nvidia are very volatile, much more so than Bitcoin. We should have similar volatility to Meta, just above sort of Alphabet and Apple and those sorts of things. Microsoft is the least volatile tech stock, and Bitcoin and gold, gold and gold have materially lower volatility than any of the world's largest stocks. So just to frame the idea that Bitcoin is nearly as crazy as people perceive it to be, and gold is certainly something with quite low volatility. The drawdowns, the maximum drawdowns on that index in the last 10 years. Bitcoin, everyone knows it can go down a lot like it did in 2018 and 2022. Gold goes down a bit. It has had large drawdowns in the early 80s and in 2013 and a couple of other moments, but those were the big ones. And gold is not much worse than gold. So that's the point. You're getting the pickup in the performance with the Bitcoin inclusion, but not a material pickup in the risk. And we're nearly there, John, before we'll come to you and get into the interesting conversation. That's the Sharpe ratio, something that fund managers look at the risk-adjusted return. So over the 8-year period, we've got Bitcoin at 24%, gold at 21%, gold at 26%, with the volatility over the whole 8 years for Bitcoin has been 65%. Obviously, it's much lower more recently. Gold 14% on average and gold 17%. And there you have the Sharpe ratios. Now, the Sharpe ratio of gold has shot up in 2025 because of the strong performance, but it was a lower number before that. But nevertheless, Bold gives something on extra as a risk-adjusted return. So why Bold? I think that we can all talk about why we love Bitcoin and why we love gold. They're big, liquid, alternative assets. They're neutral. They're very relevant in an uncertain world. We'll get to that conversation. But I don't think I need to make that argument. What I'm saying is you should own Bold rather than Bitcoin and gold. And here are the benefits. You have the risk managed through the asset allocation, the same amount of risk in each asset. There's an excess return courtesy of the rebalancing transactions. And overall, there's a smooth journey. It's much easier to own Bold than it is to own Bitcoin and gold. And there you have it. Bold versus the global money supply. The money supply has approximately doubled over the last 10 years, and Bold's done 5, 6, 7 times that. It's got the highest correlation pairing with the money supply of any asset or asset combination that I can find. Global equities are not too bad for the money supply, but you get about 1.3x on the money supply, whereas on Bold it's 5, 6x. So that's where we've been. Now, John, what do you think? What are your comments? I noticed you politely did interrupt.
No, I didn't, Charlie. I was keen to hear what you had to say. I mean, we've had these conversations over the years, so nothing really surprised me there. But it's interesting to hear you lay it out. I suppose the one thing that I would say is probably to explain why I'm on this podcast. Because if you follow the crypto community for a long time, gold has been maybe not the enemy, but it's certainly been the asset that Bitcoin maximalists have been aspiring to in terms of market capitalization. Bitcoin marketed as gold 2.0. But the reason that Charlie and I talk and are still good friends, despite the fact that he's taken me down this crypto wormhole in the last decade or so, is because Charlie has always recognized that Bitcoin and gold are not competitors. They have very different characteristics, and that these different characteristics lead them to be complementary assets. Having gold and Bitcoin in your portfolio is much better than having one or the other. And then the clever way that Charlie inverse volatility weights them and rebalances them just adds even more value as well. So I think it's a very clever idea. I wish more people would understand the merits of combining these two assets together. And and I certainly wish them every success in promoting this product.
Thanks, John. I mean, you're right. I mean, what I find quite interesting is if you go to Twitter X and you listen to the Bitcoin maxis, they make all the same arguments as the gold bugs, about the world's coming to an end and the money supply is going through the roof, and the reserve, you need to grow your reserves, and if you're a central bank, and all of those things, and yet for some reason they make those arguments and they apply them to Bitcoin, but they're gold arguments, and they've always been gold arguments. And my very simple answer to this question is that gold is the reserve asset of the real world, and Bitcoin is the reserve asset of the digital world. And if you look at that money map that we had earlier, I'll just flick back to that. There we go. What drives gold traditionally is real interest rates. So what gold loves is a lower bond yield and a higher rate of inflation. And if you get that, that's that sort of classic macro environment for gold. Also, there are other things happening at the moment, which hopefully you will tell us about in a minute. But Bitcoin just likes risk on and high liquidity. It just wants the market on fire, bond yields rising, which is normally what happens when the equity market's on a tear, and a bit of inflation. And if you get that, which is the same environment that the banks like, by the way, and that's quite interesting that Bitcoin's in the box sitting next to the banks, which I don't think Isabella Kavitska made some good comments on that the other day, but a lot of people don't recognise that, I think. So Bitcoin's the reserve asset of the digital world, and unsurprisingly, it correlates with internet stocks because it is an internet stock.
Certainly, fundamentally, it looks like one. And if you look at the correlation of returns, it stands out very strongly correlated to returns of not only just Nasdaq, but the high beta Nasdaq stocks, the ones that you've highlighted in your conversations earlier. And that's why gold is such a perfect fit. Well, what I say to people when the Bitcoin question comes up, because it does come up often with investors, particularly with family office investors, that seem to be that sweet spot of investors in Bitcoin. As I say to them, I said, look, it's not for me to say whether you should own Bitcoin or not. You've got to make your own decisions on that. But what I say to them is, if you've made that decision, if you've added Bitcoin to your portfolio, recognize what you've done. You've increased the risk of that portfolio tremendously, even if you've only put a few percent in there, because of the much higher volatility that Bitcoin has. And if you increased the riskiness of your portfolio, then it means you need to diversify more. And look, you can use a number of things to diversify that risk. Historically, you'd have probably chosen bonds. But certainly over the last few years, gold is standing out as a much better diversifier of those sort of risks, equity risk or equity-like risk. And therefore, adding more gold to your portfolio, if you've made a crypto allocation, just seems to make perfect sense for me.
Yeah. So, John, tell us about the gold market. I mean, there's no one in the world who knows more about gold than you.
You're
And
very kind and flattering, I suspect. There are
well,
lots of people that know a lot about gold. I've just done it for a long time.
okay, well, that's modest of you. But when I have a gold question that I can't answer, I call you. I
Mm.
mean, that's generally the person I come to. And could you just sort of outline why, in your view, you've seen it for 40 years, as we established earlier, what's happened over that period? Why now? Why did it stop in 2011? Why was it so weak in 1999? Could you sort of summarize those 4 decades of why gold's such a star asset these days?
Yeah, I mean, big question. Summarize four decades in 3 bullet points.
Yeah.
Okay, so there's a couple of things that I would say. Um, when times are good, people believe they don't need to own gold. So what do I mean by times are good? When economic growth is strong, when fiscal deficits are low or maybe even surpluses, when global productivity growth is high, when globalization is increasing. So this sounds a lot like the early 2000s to me, when we were experiencing the benefits of the peace dividend from the end of the Cold War. Economies were doing well. The US was running a surplus for a couple of years. Even the UK, I think, for 1 year ran a fiscal surplus as well. And gold languished. Wind it all forward now, and we're in a very different environment. Productivity growth has fallen sharply, particularly since the global financial crisis, and that's led to, I think, a lot of I don't know, conflict within and potentially between countries, as well as zero-sum economics seems to be the flavor of the day. If you're rich, Charlie, and I'm poor, that's, you're rich because I'm poor, rather than we all get rich together in a growing environment. I think geopolitics has got a lot to do with it as well. I see that we're in a period of flux. We've gone from a condition when the United States was the recognized single hyperpower of the world to one where there is tremendous competition now between China and the United States. And by some measures, China's economy is now exceeds that of the United States. And yet the US dollar, the US economy, certainly the financial aspects of the US economy still remain pretty dominant. But we're in a transition away from this single hyperpower towards a number of important powers, two initially, perhaps joined by the European Union if it decides it actually wants economic growth, and then potentially India some years down the line. So during these periods, I think, of economic transition, I think it's natural for risk and uncertainty, particularly geopolitical risk, to be high. So people ask me, what would return gold to be an out of favor asset? And I'd say, well, look to the past. Look to that period in the early 2000s when, when gold was going up in dollar terms, but pretty much flat in every other currency, unwanted and uninvested generally, very much a jewelry demand asset. Well, we need to get back to a period of high productivity growth, economic collaboration between the major nations, running sensible budgets, fiscal surpluses, demographic dividends that are positive. And it's really been the move from that state to where we are now that I think has really made gold a much more interesting asset. And it's been a major contributor to its, couple of decades long bull market.
Yeah, and it's been an impressive bull market. And I totally agree with you that if the world was normal, whatever normal means, well run, if every government was Swiss and the budgets were balanced and there was neutrality and fewer headaches, then the gold price, there would be no reason to buy gold, would there?
Certainly much less reason to own gold than there is now. I think there's a few other things that specifically have taken place as well. And I think a lot of this comes back to portfolio construction and investment portfolio theory. We've been taught that the way you invest is quite simply have most of your investments in risk assets and that you have a diversification in bonds. The classic 60-40 portfolio. And if you think about the data period that has been used to establish this, it's pretty much the last 30 or 40 years. It's the period during a tremendous bull market for government bonds because Paul Volcker, chairman of the Fed, came in and smashed inflation, hiked interest rates massively back in 1979-80, and we had a 40-year bull market in bonds. So if you look at historic returns of equities and bonds and the correlation between the two, yes, there's no doubt that bonds offer some protection to your portfolio, but a lot of that has been boosted, I suspect, artificially by the fact that we were in this period of disinflation, which ended pretty evidently back in 2021. So if you look at correlations between bonds and equities now, they're much less reliably negatively correlated. And if you're not going to get the same diversification benefits from bonds as you've expected to do in the past, then you've got to look for something else. And that's why I think gold has attracted a lot of attention from investors over the last while.
So, Kit, why don't you come in and answer that?
Well, yeah, I just actually had a sort of follow-up question, really, which is, when you think about the future correlations of assets, it certainly matters where you start from, and gold has performed that role historically. But with the way its run has been in the last couple of years, do you expect those anti-correlations to hold with, I guess, US equities in the future, starting from where we are today?
I mean, look, it's a tricky one. If you look at the sort of performance we've seen in gold each year over the last 3 years, certainly exceeded what our longer term models would expect. We've done quite a lot of work trying to model future gold returns. We get to a number that's about US inflation plus 2 to 3%, which is not too different from global nominal GDP. And yet we've delivered 19%, 26%, and 67% US dollar returns in gold in 2023, 2024, and 2025. So clearly something's changed. Is it possible that we're going to see slightly different correlations going forward? I think it is, particularly if you're in an environment where investors are going to increase their allocations that they have in their portfolios from very low single digits up to something more justified based on historic performance. And then in terms of future performance, again, if bonds aren't going to be the anchor to the portfolio for reasons of fiscal splurging taking place around the world, then maybe gold should even be gold allocation should even be higher than the sort of 5 to 10% allocations that historical portfolio analysis would suggest. So it's possible, much in the same way that because we had a 40-year bull market in bonds, that distorted some of the correlations in the data sets in history. If we're on the cusp of that in gold, then yeah, potentially the correlation will be different in the future from that we've seen over the last 10, 20, 30, 40 years.
So, John, going back to Bitcoin and gold, what they have in common is limited supply. What they also are neutral assets. They have no CEO, they have no profits, and they're both highly liquid assets. Obviously, gold's more liquid than Bitcoin, but they're both highly liquid assets. And that makes gold stand out as a commodity because you can hold it in physical form with huge liquidity, much more so than any other that you can hold in physical form. So that takes out oil. And in the digital space, obviously, Bitcoin is leaps and bounds ahead of all of the rest. So they're very clear choices. So there's no one's in charge, no one set the rules. The crowd, the global financial markets just price these two assets according to whatever the news is out there and supply and demand that comes about. The thing about gold that I find most fascinating is how in the late 90s, the Europeans, particularly the UK, were famously reducing their central bank gold reserves. And but they continued to fall around the world until 2009, 1 year after the credit crisis. And then they started going up. And no one at the IMF or any of those, or World Bank or any of those places told anyone to buy gold.
No,
Somehow or
not.
another, over the last 16 years, those central banks came to their own decision that the barbarous relic was relevant again. So, why do you think, how did they come to that decision? Why did they choose gold? Obviously, I'm not suggesting they would have chosen Bitcoin. It's been too young anyway for a central bank to get their head around. But why did they choose gold rather than, a more diversified fiat currency approach or inflation-linked bonds or equities or whatever else they could have done? They went to gold.
Yeah, I mean, they went to gold, I think, because gold managed to demonstrate very well through the latter part of the 2000s and into the global financial crisis and for the couple of years thereafter, that during a period of crisis, of confidence about government bonds, about fiat currencies, about indeed the whole global financial system, is that gold's an asset that performs very well. Now, it's worth unpicking a little bit about the central bank behavior, because it's not as if the European central banks that sold so much gold in the 90s and the 2000s have turned around and started to buy. Rather, what they've done is they've stopped selling. The buyers have been almost exclusively emerging market central banks. Now, emerging market central banks didn't have much gold at the end of the gold standard because they didn't have much in terms of foreign exchange at the end of the gold standard. These were much smaller economies back in 1971. Their foreign exchange reserves had ballooned, particularly since the Asian financial crisis in the late 80s. So trillions of dollars of increased foreign exchange reserves, recognizing that you needed to have a hard currency backing your emerging market currency, and you needed to stop people borrowing in dollars just in case your domestic currency weakened. So they'd shored up their own balance sheets in dollar terms or in fiat terms. But what they hadn't done is they hadn't added gold. Now, along with the global financial crisis, we obviously saw interest rates come down a lot. We saw credit ratings on many government bonds cut. And therefore, the opportunity cost of owning gold, which doesn't pay an interest rate, that opportunity cost fell a lot. So on the one hand, you had demonstrated performance during difficult times. And on the other hand, you had, well, it isn't costing you as much to own gold in foregone interest income. So emerging market central banks started buying gold, and they've bought gold, as you said, every year since 2010. And they've bought, in round number terms, between 2010 and 2021, they bought about 10% of the gold market each year. And then in 2022, they doubled those purchases, went from around 500 tons on average to more than 1,000 tons in each of 2022, 3, 4, and 2025. And that's been one of the factors why gold has performed so well in the last few years. It's certainly not the only factor. And I do get a bit frustrated by people simplifying the gold argument is that, oh, central banks are buying a lot of gold, therefore the gold price is going up. No, it's been a factor, but it's not been the only factor why gold prices have done well in the last few years. But it certainly gathered an enormous amount of attention from commentators. And in a way, it becomes a bit of a reinforcing or a self-reinforcing phenomena. The more that central banks buy and the more news about central banks buying, the more that other central banks pay attention to that. And I think one of the reasons why we are seeing increased interest from central banks to buy gold, we conduct a survey each year of central banks around the world, and anonymously they give their expectations on all manner of different things. But each year that we've been running this survey, more central banks have said that they intend to add gold to their portfolio each year. And I think a lot of this is because others are doing so as well, with obviously what China is doing, what the People's Bank of China is doing in terms of its reported gold holdings plays a very big role. They're the biggest holder of foreign exchange reserves and highly influential. So the fact that they're buying gold is really important. And it is a big signal to many other central banks that they should be adding gold to their reserves too.
Can you ever imagine a time that a central bank, a major central bank, would add Bitcoin to their reserves?
Forever is a long time, Charlie. I don't know. Certainly, we've started to ask the Bitcoin and the crypto asset question when we conduct our central bank surveys, and we've seen almost no interest from the central banking community to hold crypto assets and Bitcoin at the moment. I think that can change. I mean, we've seen a couple of announcements. Was it the Czech Republic that made a purchase of Bitcoin, I think, over the last 12 months? And I can see a bit like the family offices who also have a very long-term investment horizon, looking to preserve wealth more so than many other investors who are looking to gain wealth. I can see central banks looking at this, but based on the feedback that we're getting so far, it's very, very early stage. So if you can attribute the strength in gold to central bank buying, you certainly can't attribute the strength we've seen in Bitcoin in the last few years to central bank buying. That is, if they're telling us the truth, of course.
No, sure. But perhaps we should show the central banks that if they had a little bit of Bitcoin sprinkled into their gold, that they would add some good value. Now, Kit, do you have any questions for John before we let him go and look after the world's gold for us?
Yeah, I suppose was just curious to ask one thing that often comes up on the social media platforms and things is about the reality of the gold in different funds or whether it's really there. What's that conspiracy theory about? Why does it always come back? Why won't it go away? What's your view on that one?
Yeah, it's interesting. I don't know why it won't go away, although maybe I do, because gold is quite a conspiratorial asset, although not as much as silver at the moment. And people love to have crazy theories about gold that aren't borne out by facts. The one you're specifically referring to is that physically backed gold exchange traded funds don't have the gold. They don't own the gold, or they lend the gold out, or they do something with it. Now, one of my colleagues, Joe Cavatoni, who's my equivalent in the Americas time zone, published a blog earlier this year. Now, Joe was the principal executive officer of the two funds that the World Gold Council looks after, GLD and GLDM. And he's in a very good position to explain reality when it comes to the gold that's held by exchange traded funds. But the simplest way actually is don't read our blog. Read the prospectus of these funds. Read what they're allowed to do. Physically backed gold exchange traded funds hold gold in physical form in vaults on an allocated basis, so bankruptcy remote from the place where they're holding it. They are not allowed to lend it, pledge it, repo it, or do anything else. We, or rather the World Gold Trust Services, which is one of our subsidiaries in North America, they oversee the counting of every bar of gold every year. And I think between the two funds now, we've got something over 1,250 tons of gold in there. You can imagine how many gold bars they are. Each bar gets counted every year by an independent counter, and it is audited by our independent auditors. And they also do test counts every 3 months. And we have people from the World Gold Council in the vaults where they're held. on at least 4 times a year and potentially more for random visits. So I'm very comfortable in saying to people, read the prospectuses of these funds. If you believe these conspiracy theories on the internet, just read the prospectuses. But the gold is there in allocated form. It's never lent, it's never pledged, it's never repoed, or any of the terms that you'll hear, leased out, whatever. None of that.
Yeah,
Maybe
and I've come in there because one of the reasons it was so hard to launch Bold, that I was insistent that we had the quality of gold that you described, with JP Morgan as a custodian. I wanted LBMA, good delivery gold. Not only is it secure and allocated, as John describes, but it's also liquid. It's at market, so you can trade it there and then. And I think that's one of the interesting features about the gold market. Whereas if you put your gold under your garden shed, then it's no longer liquid gold. You can't pick up the phone and trade it. You have to actually take it to market physically. But if it's in one of the London vaults, then it can be traded. So, Kid, have you got any other questions for John? No? John, do you have any final word you'd like to make about Bitcoin or gold, or maybe a little observation on silver? I know that you're not in the World Gold Silver Council, you're in the World Gold Council, but it is quite fun at the moment in the silver market. So it would be a shame to not let you you
Sure.
go without that.
I mean, a couple of things I'll say before we touch upon silver. First of all, a bit of a plug for the World Gold Council. We
Sure.
produce a tremendous amount of research, data. We have lots of tools to help you look at gold and gold's historic performance and the benefits that it could bring to your portfolio. We've got a great website called gold.org, and an investment component of that called goldhub.com. I'd encourage you to go along, have a look at that site. It's free, and just have a play around, see the stuff that we're producing in terms of research and data. It's a benefit to the entire market, and part of what we do is to try and educate. You can even ask questions of us, and we will get back to you, because I like to say, if we don't know the answer about gold, we probably know the person that does know the answer about gold. So we are the experts on gold. I think when it comes to silver, as Charlie said, look at the name on the tin. We're the World Gold Council. But if you think about the World Gold Council as being owned by major gold mining companies around the world, almost all of those gold companies produce silver. In some cases, a lot of silver. So look, we do pay attention, and certainly in previous roles, I've spent a lot of time looking at the silver market, or the devil's metal, as it is known, because it is such an annoying thing to try and trade, particularly on the short-term basis. To me, silver is a retail alternative to investing in gold. And why do I say that? Well, when we make the case for institutional investors buying gold, one of the things we make the case on is volatility, which you've heard a lot about from Charlie in terms of the volatility of gold, and liquidity. And as Charlie says, we're trading hundreds of billions of dollars of gold a day, at a relatively low volatility, probably somewhere, I think you had an 18.7% level, I think it was, if I look back at the presentation. Fine. Silver is at least 10 vol points higher than gold, and probably 20 or 30 at the moment, following the enormous explosion that we've seen in the price. And its liquidity is much less than gold, a fraction. So if you think about gold and silver over the long term, they tend to perform more or less in line. The reason that people talk about the gold-silver ratio is because they tend to perform, over the long term in similar ways. And in fact, until recently, silver's actually underperformed gold over the long term, over the last 20, 30, 40 years. So by investing in silver as a strategic asset, you're getting returns that are in line with gold, maybe a little bit lower. You've got less liquidity to be able to get in and out, and you're experiencing higher volatility. So that doesn't seem particularly attractive. Now, as a tactical trade, silver can really outperform gold under certain circumstances. And that's been the case over the last 12 months or so, where we've seen a tremendous catch-up in silver, which was languishing unloved and unwanted. I think the gold-silver ratio was above 100 at one point. And now silver's caught up massively. It's benefited like many of the metals have, from the uncertainty and the displacement that has taken place because of the tariff announcements that we saw from President Trump and his administration last year. But there seems to be, from what sensible commentators are saying in silver, there seems to be a market which is in deficit as well. So maybe we wouldn't have seen such a fantastic performance in silver last year if it hadn't been for the tariffs, which resulted in a lot of gold being withdrawn from London and shipped to the States and tightening up the market and backwardation and all those good things. But it was probably coming anyway at some point. So I'm not surprised to see silver doing well. I was perhaps surprised to see it doing well so soon. Now, look, we don't make forecasts at the World Gold Council. It's one of the things that our ownership structure prevents us from doing. What I was saying to actually an investor last night when we were discussing, how much gold and particularly silver had gone up over the last 12 months. I said to the guy, I said, look, have a think about how much gold and silver are making up of your portfolio. Because they've done so well, they're probably making up an outsized proportion of your portfolio compared to what you wanted when you started to invest in both of these metals. And you've got to realize that volatility has gone up in both, a bit in gold and particularly in silver. So, if you find yourself with a large proportion of your portfolio now invested in these two metals, there's nothing wrong with taking a bit of profit sometime. Now, of course, the question then comes, what do you buy? And must admit, I do scratch my head if I was to be reducing, precious metals allocations at the moment. I'm not quite sure what other assets I'd be invested in. But certainly, in terms of silver, it's come a long way. Doesn't mean it can't go further, but with the volatility and its habit of nasty corrections, I'd certainly be cautious here.
Sure. So I think you've just neatly described why gold doesn't have silver in it, because you get the same return in the long run, but with more volatility and less liquidity. That's the same reason we haven't got Ethereum or other crypto assets on the digital side, just Bitcoin, which is the liquid one with lower volatility. And that's an important point. And also, the Sharpe ratio of silver would be the same return with more volatility, so materially lower. And silver performance all comes at once, doesn't it? It trades at a discount for years and then it gets all excitable. And, ByteTree, we're bulls on silver. Don't know for how much longer here. I think I put out a note recently saying $175 silver by 2030 to match my $7,000 gold by 2030 note that I wrote 5 years ago. But it's all happening rather quickly. and so that's a bit uncomfortable. But hey, we always like to take a profit. So I think with that, Kit, have you got any final words you want to conclude?
No, nothing else from me, except to say how fascinating it's been to sit listening to you two greats chat about these interesting topics at this time.
Yeah. Well, thanks, Kit, and thanks, John, for coming on this podcast, from all your help for when I have hard questions from ByteTree clients about gold, and they think it's me that knows all the answers. It's obviously John. And that's good, and a fabulous period for gold. And you were saying, well, if you do sell gold, what do you buy? Well, of course, you'd buy some Bitcoin, wouldn't you? That's the other alternative contrarian play right now. And
you could say that, Charlie, but I'm not going to. But
well, you're not going to say that.
No, I'm not going to say
that. That is clearly a way to take profits in gold, switch to gold, and then you've got the other side of it. So that would be my final word.
Great. Well, thank you very much to both of you for the opportunity to talk about gold to your listener base. And I would just reiterate the World Gold Council website, gold.org, goldhub.com. Go and have a look there. If you want to learn more about gold, there's lots on it. Thank you very much.
And they are excellent resources, which I use myself. Thank you, everyone.
Thanks, everyone, so much. Bye.
Cheers.